nothing is 100% in the financial markets, but the markets do have tendencies, right? Like for instance, we know that the market can only do three things. It can only trend up, trend down, or move in a range fashion. And we can take advantage of those tendencies. So even though nothing is 100%, there's actually one thing that happens so consistently in the markets. It's truly the reason why you can become a consistently profitable trader. So in this video, I'm going to reveal to you the one thing that the market does nearly 100%, or it does it so consistently that you will be able to use it as your trading edge. Let's go deeper. Hey guys, JD here. So in this video, we're going to just go deeper on what we've been building on kind of here this month. So we've been looking at the power of taking second entries. All right. And I've explained it to you. I've shown you how to count second entries. If you haven't seen that video, I'll put a link up here for you. But I'm gonna go deeper today. Really, yeah, I'm gonna go a little bit deeper today for you, because also we need to talk about. Here's a new term for you guys that's out there. You probably heard it before. I haven't been using it, but it's actually exactly what we're doing, and it's called mean reversion. Okay, so the one thing that you can truly bank on in the financial markets is that mean reversion is a real thing, and it's gonna happen. And just to simply explain it to you, all it means is that once the market is trending, right? So we know the market can do three things. Once it's trending up or trending down, what will happen is once it gets so far from the average price, it's going to pull back to the average price. The mean equals average price. Reversion is the pullback or the small retracement that you get in the markets. And so once prices get so far away from the moving average or from the average price, they're going to pull back to the average price. Okay. That's the one thing that happens consistently in the market. I mean, now that is nearly 100% going to happen. The only problem is you may not know when it's going to happen, right? But it's going to happen. So you've all heard me say it a cajillion times. I use one indicator, and that indicator is the 21 EMA. The reason I use the 21 EMA is because it acts as the average price, exponential moving average. So the 21 EMA is the average price. And so, hey, I know what you're saying. Why the 21 though, Jay? Why? I have several reasons, right? Or there could be several reasons. Some would say, hey, there's 21 trading days in a month. If you're on a day chart, the 21 EMA is going to give you the best average. Some may say that, right? Some may say, hey, the 21 is a Fibonacci sequence number. Fibonacci numbers hold great weight in the marketplace. Some may say that. I'm saying I didn't start winning until I started using the 21 EMA. So I teach using the 21 EMA. All right. That's my explanation of it. All right. But so what's happening is this: you get in a trend, you're trending, prices start trucking, right? And the 21 EMA is here, prices are up here. You're going to get a mean reversion. Prices are going to come back to the average price. Once they do, that's your opportunity to enter into the trend. All right. So we're going to go to some charts so we can look at this. And I'm just going to go to some binary option charts so I can scan through real fast to find some trends and just show you, if you've never seen it before, how prices continually come back to the mean, to the 21 EMA, and how that's your best spot to enter into trades. And when you learn how to do it consistently, you will start to profit consistently. Let's go to the charts. All right, guys. So like I said, we are using the 21 exponential moving average. Okay. So this represents the average price. Now you see right here, we got a nice little downtrend going, right? What I want to show you is just how prices will always pull back. So we're trending down, then you get the big drop. Another big drop. So prices is here, right? But the average price is way up here. See the difference in there? See that gap? So so prices is here on this low. Well, I guess it's this red low here. And the average price is up here. Let's just say that this is, 200 or something. and up here would be like, you know, 210. So the average price is like 210, right? But with this downtrend, we're at 200. Well, prices have to come back to the moving average or to the average price. So what I've been teaching you with second entries is just how to count legs, all right, to back to the EMA, because the market moves in twos. And so when you get a push up first entry, push up second entry short, right off the EMA, prices come right back to the average price. This is where you go. You go right there, boom, big drop, right? Big drop. Now, prices keep on trucking. Look at here. We get down here, prices hit down here, but the average price is up here. So what are we expecting? We're expecting to pull back to the average price and push up first entry, pull back second entry short. When you go right here, again, this starts the continuation of a trend. Same deal right here. Prices are way down here. The EMA is up here. Here's the average price. What are we waiting for? We're waiting for a two-legged pullback. This one is choppy. This one is pretty choppy. But if you just use colors, it's kind of push up first entry, push up second entry short. Then boom. But this one was choppy. This one you probably would have a loss in there, especially if you was counting per the stem. And that's the thing. You can count legs per the stems or just kind of watch colors. You know, I can't say which one is best. They both can work. They both cannot work. You know, nothing is 100%, right? But the point in this video is that when prices get so far away from the average price, they're going to snap back. They're going to snap back. They're going to snap back. I like to think of it as acting as a magnet. So once prices get so far away from the average price, the EMA tends to act as a magnet and pull prices back to it. All right. So some people have created strategies where that's actually their strategy to, you know, once they get so far away from the EMA, they feel confident taking a trade where they know that the EMA is going to pull them back to them. But the problem with that is counter trend trading, right? When you have a definite trend, your best bet is to go with the trend. Okay. If you've ever heard the term buy the dip, right? This is what buying the dip is, right? Or selling the rip in this case. But that's the theory, right? The theory is once prices pull back, all right, that's your opportunity to enter the trend, and you'll be entering it going with trend. All right. And you always want to be going with trend if possible, you know. Now you can go counter trend here on pullbacks when you get really advanced, all right? When you really know what the market is doing, you really can read a price chart. But until then, just go with trend. It's much easier to go with trend, all right? It's much easier to buy the dip. But I'm explaining something to you why I'm saying that like it's easy, and I'm showing it like it's easy. I'm going to explain to you though why it's actually not easy, all right? And it's not because this theory is pretty simple. You get far away from the EMA, you wait till it to come back, then you sell, right? That's simple, right? Let me explain to you what the hard part is. The hard part is that your human tendency is going to be to say, we've already trended down. I've missed the run. That's going to be your natural human tendency to say, I've missed the run. And then once you start seeing prices pulling back, the next thing you're going to say is, oh, we're finally reversing and we're probably heading back up here. I can make more money if this thing reverses and goes up here. That's going to be your natural tendency to think that this minor retracement is actually a reversal. And you're thinking, okay, we've dropped from price was up here, we've dropped all the way down here. If we reverse and keep going, I'm gonna make way more money. That's what you're thinking. That's gonna be your natural tendency. So even though I'm saying buy the dip, like it's simple, it's actually much harder to do just because your natural human tendency is going to be to do the opposite. And there's a lot of things in trading that's like that your natural human tendency is wrong. And this is one of those situations, because the truth of the matter is that you never know how far a trend is going to go. Okay, let me say that again. You never know how far a trend is going to go, and it usually goes farther than you think. All right, like at this point, when we get down here and you've seen all this, when we come back up here to the EMA, you're definitely thinking reversal time, right? You're thinking we've dropped too far. This thing has to reverse. It's time to head back up. I'm gonna catch this reversal all the way up. That is a losing strategy. Your best bet is always to go with trend. And just think, if you go here, if you sell here instead of buying, you catch all of this, because the market moves in twos. This is like the center of the pattern. This is leg one. This was leg two. The market moves in twos. That's why it's important to learn and understand the market cycle. That's why it's important to learn and understand that the market moves in twos. Those things, all this stuff comes together and can help you. But your tendency is going to be to say, man, this thing has failed too far. It's probably going to reverse. But you never know. You just never know. All right. So let's see if we can find an example going along. Hold on a second. All right. So we got looking at the dollar CAD. Here's another example, right? So market broke higher than here, started trending, right? We're trending up. It got up to this high. Look where the EMA is at. EMA was, here. The EMA was here. When this price was here, the EMA was probably here. We're too far away. What did it do? Mean reversed back to the EMA. All right. Then prices got up here. EMA was down here somewhere. What did it do? Pull back to the EMA. Prices got here. Nice gap. You can see the gap in between. We're distance away from the EMA. What is it going to do? It's going to pull back to the EMA. And this one pulled back to the EMA and broke all the way through it. But the trend wasn't done. See, everybody here, everybody here, everybody here, everybody who went short here, everybody who went short here is thinking that the trend is over. But you never know how far a trend is going to go. Also, we expect two legs. This is leg one. This is the center of the pattern. Leg two went further than leg one. The market moves in twos. So everybody who wanted to go counter trend here, 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 and here lost. All right. But if you were still thinking long, okay, you could have got back in this trend for another ride up here. This thing couldn't even touch the EMA, pushed up. Got here, couldn't even touch the EMA, pushed up. Got here. All right. So here, we're way up here. What does it do? Pull back to the EMA like a magnet. And this one looked like it was a push down first entry, push down second entry long off the EMA. You take second entry longs off the EMA, bang. All right. Bang. Even here, up here, price is here. What does it do? Pull back like a magnet, bang. It's running again. Okay. Mean reversion. All right. I've been teaching it to you as far as second entries or two legs back. But what it is a mean reversion. Prices pull back to the average price. And the 21 EMA is your average price. If you just use this one tip, right, you can truly simplify your trading. You can stop jumping at every small price movement, and you can wait till the market is trending, and you can take advantage of mean reversion, because it happens anytime the market is trending in any market you are looking at. All right. So this is a great time to like, share, and subscribe. I hope you guys enjoyed this one. I greatly appreciate all the comments. Hit me in the comments today if you liked this one. All right. I really appreciate it. And if you need to learn price action, I'll put a link in the description for you. And I also just did a video where I discussed where to put your stop loss, which is Another important thing, if you're like trading the Forex or you're trading futures and we have to have stops, you need to put them in the right place. Because if you keep getting caught with the kiss of death, where it comes down, touches you to the tick and then takes off and goes exactly where you want, that sucks. It really gets my goat. And in that video, I'll show you exactly where to put your stop. So check this video out right here. It'll put you on the game on that. And until next time, my name is JD. And as always, I wish you increase on the Sutton. Bye-bye.